Oh, hi, Katie. Good
Hi,
morning.
how are you?
Sorry for the late reply yesterday. That was kind of a long day, the way things turned out.
Oh, that's
So
okay. That's okay. I knew we'd be chatting today, so all good.
good, good. And like you say, afterwards we can hook up if you like for
Perfect.
an additional thing on chapter 6, which is a tough little chapter. There's no question about that.
Yeah.
Um, chapter 7, some people find this one kind of fun, I think, a little bit. So we'll see. Hi, Callie. How you doing? You have your child under control, Callie? Okay. Just double just double checking. Hi, Brad. I don't know if Brad's there. He's just gonna silently listen in on us, huh? Okay, maybe just wait another. Oh, it's actually 12 o'clock already. All right, I guess we'll get started. The Saturday group is never the biggest, huh? I know you can't see me too terribly well, but that's me. And I need to sit here because I got to use this little desk. Okay. Chapter 6 was a tough one, and we're not done with it by any means. So let's go into chapter 7, and then afterwards we can see what we want to do. Let me share the screen. Share screen. I was in a meeting at school yesterday with almost 300 people. That went on forever. Okay, you can see the slideshow now.
Yes.
Okay, think of chapter 6 as the start of learning a new, longer income statement. That income statement begins with our gross sales minus our three contra sales accounts: sales discounts and allowances, I'm sorry, sales returns allowances, sales discounts, and credit cards to get net sales. What we're going to learn now is that we will subtract from the net sales something called cost of goods sold. Cost of goods sold, which is simply what we paid for the goods that we sold. And we're going to talk about different methods of coming up with that cost. There are certain ways that companies can choose to do it. And I've got the PowerPoint, then I've got a little Excel thing that I think will be helpful when we go forward, huh? In coming up with the cost of goods sold, we got to know what we purchased and we have to know what's in the inventory. Don't worry about manufacturing here. That's for 240. Okay, the cost principle. The cost principle requires that inventory be recorded at the price paid or the consideration given. In other words, we should know that everything on our balance sheet, whether it's an inventory item or a prepaid expense or a factory building, is at the cost of that item. And that can include, of course, the invoice. We bought a plane from Boeing right here for $1 million. And then we paid another company to fly that in. That would be a freight charge. That would become part of the cost of the plane we bought. And if we need to inspect it or perhaps paint our logo on it, all of those items become part of the cost of the item. Now we get into the guts of this thing, okay? Inventory costing methods. And these four things here are pretty much the bulk of the chapter. Companies have different methods they're allowed to use to cost their inventory and consequently the resulting cost of goods sold. FIFO, first in, first out. FIFO, LIFO, last in, first out, weighted average specific ID. FIFO, first in, first out. We're going to pretend, and I'm using the word pretend deliberately, we're going to pretend that we're always selling the oldest item in our inventory first. last in, first out, we're going to pretend that we never ever sold the first item we bought 40 years ago because we're always selling the newest one first. Specific ID, that's if you buy a car. The company has to know exactly which item you bought, which Ford Edge, and the weighted average, which is just that. So let's take a peek here. I'm going to skip that method because I want to start with FIFO. And I'm tired of people asking if that's me in the picture there, okay? First in, first out. First in, first out. Last in. I want to find first in, first out. And if I don't see it in detail I mean, I looked at this earlier, it should be here. Okay, it's time for my template. First in, first out. Time for my Excel thing here, okay? I think this will explain it better than anything in that PowerPoint. Let me just move this thing out of my way. Oh, for goodness sake. You can see the Excel sheet now?
Yep.
Okay. This is what we're going to be looking at throughout the chapter, okay? FIFO, a company says we are choosing the accounting valuation method called FIFO, first out. First in, first out. In other words, it kind of mimics what most companies do. Not necessarily. So let's see what we have here. We have a beginning inventory and 4 purchases. What is the first in? In other words, what is the oldest? This here, the beginning inventory, is always the oldest item. That's what you had at the beginning of the month. That's your oldest. That's your first in. Next that came in was the purchase on the 10th, the 19th, the 22nd, and the 31st. Okay, so we bought 500 and the price was $3.20, which means that item cost us $1,600. And then we have these different purchases, 500 times 4, 800 times 5, etc. Okay, first in. This is first in. This is last in. So let's understand that. That's not too tough, just that little principle there. Now we have to take this total, and this is an important line, cost of goods available for sale. Cost of goods available for sale. This is the most we could have sold. We had 500 books in our bookstore, and then we bought another 2,000 here. So the most we could have sold was 2,500, 2,500 books. And the total we paid for those 2,500 books is just 12,500. Now, everything we're going to do after this is going to drive through this number here. At the end of the month, we have to count our inventory, unfortunately, because we're not using a perpetual system yet in our class, okay? So we have to count the inventory. And in this example here, it's split up evenly. At the end of the month, we had 6,100 left in our inventory, which means we sold 6,100. Oh, I'm sorry, what do we got here? Oh, those are dollars, I'm sorry. Let me take a peek, 1,518. Ah, good. I went too fast. Here we go. At the end of the period, we had 1,500, and this should say beginning inventory, I believe. Let's fix that, sorry. Ending inventory. Okay. I'm telling you, in this example, we sold 1,500. Under FIFO, which of these 2,500 did we sell? We sold, oh, how you doing, Kelly? Who's that? Hi,
Sorry, my daughter.
your son? How old is he?
My daughter. She is 3 years old.
Hi there, how you doing? Good to see you. All right, Mom, gonna ask Mom a question here. Okay. The inventory is 1,500 units. That's how much we had. That means we had 1,000 left. Do we agree?
Are you, where did that, so if you sold 1,500 out of the 2,500 that you had there,
Right,
would
that's what
the ending, so wouldn't the ending inventory, oh, okay,
be 1,000. It's 3 and 3 and 4, 1,000.
got it, okay.
Hey, how you doing? What's your name? I'm sorry. Da, 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 da. Never mind. I'm sorry. I'm so sorry. You people are paying for an education. Okay. This is your cost of goods sold here. Okay. I'll put that there just to, okay. We can either choose to calculate the ending inventory or the cost of goods sold. Okay. And here's what we do. Cost of goods sold. Cost of goods sold. Hold on here. 45, 50. I don't want to confuse people. Oh my goodness. Oh my goodness. Hey there. Okay. Take a deep breath. We sold 1,500. This is your cost of goods sold here, okay? This line here, we sold 1,500. First in, first out. What did we sell first? The beginning inventory, okay? We sold the beginning inventory first, and that did belong there. That was correct. We sold 500 from the beginning inventory. We sold this 500, and we sold 500 from this layer. We sold 500 from that layer. We're picking up the prices for those three. 500 times 320, 500 times 4. And we did not need the whole 800. We just needed 500. We multiply this out and add the numbers up, and you get your cost of goods sold. Does that make a little bit of sense just to get started? You're going to be working these layers down, okay? We could have done the ending inventory calculation first if we wanted to. If FIFO is first in, first out, that means we have the new stuff still in the inventory. So that means we still have this 400. We still have this 300 from that layer, and we have the 300 we didn't ship out of this layer. You add the two numbers together, they just happen to come out the same. 6,100 times 2, 12,200. Okay? Let me just point out one other thing. The cost of goods available line minus the ending inventory equals the cost of goods sold. Cost of goods available minus the ending inventory equals the cost of goods sold. Therefore, you did not really have to do both calculations, because if you've got one, you got the other. Cost of goods available minus ending inventory equals cost of goods sold. So cost of goods available minus cost of goods sold will equal the ending inventory. Questions, anybody? FIFO. FIFO. Let's keep in mind that three of these four inventory cost methods have nothing to do with the physical movement of the goods, okay? It's an accounting choice companies can make, and we're going to discuss why they make these choices the way they do, okay? So here we go. I think we're ready for LIFO. LIFO, the most counterintuitive one, huh? LIFO. We're working with a different set of numbers here, okay? So this time we had a beginning inventory of 500. Then we bought 300, we bought 600, we bought 200, we bought 400, right? We get our cost of goods available, both in units and in dollars. Both in units and in dollars, okay? So now we sold 1,500 in this example. Which one do you think we sold first, Kate, under LIFO? What was the
Oh,
last
sorry,
one
I'm
in?
muted.
What was
I
that?
Sorry, I was muted. The 400, so the last one.
Yeah, we sold that 400 times 5, and then we sold 2 more. That's a total of 600. And then we sold 600 more here. And then we sold 300. Here we sold the whole, it looks like we sold everything, okay? If I did that correctly, 4 and 2 is 6. No, we sold 1,500 out of 2,000, right? 4 and 2 is 6, and 6 is 12, 1,500. We costed out. There's our cost of goods sold. We now come up to the ending inventory, which is this. We never got back to that layer, right? 500 times 2 is 1,000. And 7,200 minus 6,200 equals $1,000. Make a little bit of sense so far? I'll let Callie join us. Hey, Callie, let me show you what we were just going over here. We went through FIFO right now, right? First in, first out. LIFO, last in, first out. Kate, do you want to tell Callie which ones we would have sold first on the last in, first out?
Well, the last one's in, so it would be the 400 layer.
And then
The one just before that, which is the 200 layer, and so forth.
yeah. So under last in, first out, the assumption is we sold the most recent item. Of course, that's probably not true, but this is just an accounting convention. Last in, first out. The most recent one is last in. We sold 4 plus 2 is 6 and 6. And then we needed some from this layer here. Okay. You have any questions, Brad? Let me know. I'm assuming that you're listening in here. What do you think, Callie? Make a little bit of sense? Not yet. Go ahead.
No.
Okay.
I just confused. When we can choose LIFO, when we can choose FIFO.
You can choose any one you want. Companies can choose whichever one they want. There's no rule about it. Okay. And when we get through this little slide here, this Excel sheet, we're going to have to understand why a company might choose one or the other. Okay.
Okay.
So, but the key thing for now, first in, first out, we start here. Last in, first out, we start there. Okay. Those two are not too hard, I think. And now we're going to get into a third one. This is the easiest one. The easiest one. Average costing. Again, we're going to go to the cost of goods available line, huh? And I guess this is the same numbers we had, but that's okay. Cost of goods available. Again, we had the beginning inventory plus the 4 purchases. That was the total cost. You see that 360? That's simply the average on that line. this total dollars available divided by total cost of goods units equals the average cost, okay? Don't make this mistake students make. They add these 5 numbers down and average them. Wrong. The only time that would ever be right if all the prices were the same and the units were the same, okay?
So which numbers does it factor in then, if not the beginning inventory?
You take the cost of goods sold available line and just take the dollars divided by here. 7,200. 7,200 divided by 3.6, okay? 0.7200, not 3.6, divided by 3,600. Or was it 2,000? I'm sorry. Divided by 2,000, right?
Yeah.
There's your 3.6, decimal off a little bit. Okay.
Would the number be different if you were to take those units, like add up the 3, the 4, the 4, and the 5, and average?
Oh yeah, absolutely. 2 and 3 is 5, and 4 is 9. 1350, 18, right? 1850. Yeah, don't even think about doing that.
That was totally my intuition.
Yeah, see, you got a different number.
Mm,
It might not be a big difference, but it's significant, huh?
yeah.
3.7, so you don't use that number. Okay? Everything we're doing with these 4 methods is going to be driven via the cost of goods available. Well, let's show you how easy this method is, okay? We know we're going to use an average cost of $3.60. How many did we sell? 2,000. 2,000 times 3.6. I'm sorry, that's what was available. How many did we sell? 1,500 times 3.6 equals 5,400. How many did we have in the ending inventory? 500 times 3.6. You get the idea on how this one's a bit easier, Kate?
Yeah, no, that makes sense.
You don't have to worry about any of these layers, okay? And again, if we did not know these numbers here, if we did not know those numbers, we could take this minus this to get this. Or if you felt more comfortable doing the inventory first, then we could take this minus this to get this, okay? Inventory plus cost of goods sold equals your cost of goods available. A little tip, when you're doing the test, you might get a layer to do in a multiple choice question where there's 1 million items in the beginning inventory. And then they purchased another 10 million. And then they sold 10,900,000. So you only had 100,000 left. Start with the inventory number because it's much lower and easier to work with. What I'm trying to say is in this problem, I think it would have been easier to calculate the ending inventory first because we only had 500 items. And the average cost was that when we get back up to the more difficult ones, okay? So that's 3 of our 4 methods to get started. Now, specific ID, they are giving you the exact items they sold. I bet there's going to be a question on the test along the lines of which of the 4 accounting inventory costing methods absolutely reflects the physical movement of the goods. That would be the specific ID. This would be for a car dealer, right? Cars, big ticket items, car items, a car. I bought a car from Perry Lincoln 3 years ago, and we made the deal, and I chose my Ford Edge, right? Paid the guy. He didn't then tell me, go out into the parking lot and drive off with any Ford Edge that's on the lot. No, he gave me the keys to a very specific car, and he has to know that at that moment in time, he sold that particular car to me. He has to know what car I bought. He has to know the vehicle identification number, the license number, serial number, everything about that car. The reason a car company has to use specific ID is in case there's a recall or an accident. Boeing, they make jets, they make 747, 767. They make the biggest passenger planes in the world. They have to know, God forbid there's an accident or something goes wrong, they need to be able to trace everything in that plane back to that particular item. So specific ID, you know exactly which ones you sold because the problem will tell you. And I hope they don't try to mix us up on the problem with some goofy syntax, which I'll demonstrate after this. So again, we had 500, 362, 2,000. Which ones of these did we sell? You see what it says here, Callie? 300 came from the beginning inventory. So you go to beginning inventory, okay, 300 times 2. 500 came from the purchase of 119, right here. 119, 500 times, that should have been 4, I guess, huh? 500 times 4. Okay. Okay. And then 400 came from the purchase of the 31st. So our cost of goods sold is this number, 4,100, subtract from the 72 equals the 31. What do you think, Kate? Does that make sense?
Yep, that makes sense.
See what they're doing, Callie? They're telling you exactly where it came from, right?
Why not 300? Why is 300 and not 500?
Okay, we had 2,000 cars in our parking lot, right?
Mm-hmm.
We sold 300 cars that were in this inventory here.
Mm-hmm.
And then we sold 500 more, and they came from these 600. And then we sold another 400, which came from the 31st. They're telling you where it comes from. Still a little confused, Callie?
Yes.
Okay. Specific ID, specific identification. We have to know exactly which cars we sold under this method. So Ford Motor Company, or let's say Perry Lincoln Ford up in on Hitchcock there, Perry Lincoln Ford has to know exactly where their cars came from in terms of their parking lot. So 300 came from this part of the parking lot, put it that way. 500 came from this part of the parking lot, and 400 came from that part. These are the ones they actually sold. They actually sold those cars.
Can I pipe in? So Callie,
Sure.
if you think of the cars under beginning inventory being like red, and then the cars purchased on March 10th, which is the next line down, being yellow. So if you then they're telling you that they sold X number of red cars, or in this case, 300 of red cars, and then they didn't sell any yellow cars. They only sold blue and green. So that's how they're kind of identifying it.
So you the problem will be give you the same
Yeah, so they'll tell you which ones they sold, if they sold red or blue or green, and that's that, and then you just associate the price with that
So
In this case,
every
it's
condition.
Mhm.
Yeah. Oh yeah, yeah. I
You
got.
like the color example, Callie? Yeah, good, Kate. That's good. Yeah, 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 exactly. Whatever works, right? It's called the best practice in my field, huh? So those are the four methods, okay? Now, if you were in my 230 class, you would be handed this piece of paper and expected to complete it. And you're going to have to do that a lot in your homework. And when you come to your test, the multiple choice questions, you're going to get, I guess, mini versions of this type of thing. Okay? You'll get a question where they'll give you the beginning inventory and a couple of purchases. And then under the method, they're going to say, what's the profit? And we're going to get to that in a moment, okay? Now let's go back up to the top and try to understand a few things. Callie, you asked a good question. You said, when can you choose these methods? Well, the answer is companies can choose whatever method they want for accounting purposes, except, I guess, specific ID. So let's see what we have here. Cost of goods sold under FIFO, $12,200, right?
Mhm.
Is the cost of goods sold going to be the same for all methods? No. So cost of goods sold under FIFO is going to be lower if there's a God in heaven here. It's going to be lower. Hold on here. What was it before? That's the cost of goods available. I'm so sorry. Cost of goods sold. There it is, 6,100. Jesus. 6,100. Cost of goods sold. 6,100 under this method. Under LIFO, it's going to be higher. Under LIFO, it's a little higher. 6,200. And then the average would be here. The 5,400, I guess. Oh, we can't compare them because we're using different numbers. Okay, so hold on. Here's what I want to get across. You see the 6,100 here? Let me mimic these numbers. I'm sorry to be confusing you. Let me just try something real quick here. Let's use the same numbers. I've been using this thing for a long time with different classes, and I guess I saved it. Let's see if this works here. Okay, hold on. Just give me a moment here. Oh, I see. I see. Just give me another second here. That's how you learn, right? Okay. 310, 19. Here we go. This should work. Copy. Copy. If this doesn't work, I redo it very, very quickly. And then we had a beginning inventory of 500, and this was 3.2, 300. Okay. I'm so sorry, guys, but this might be a good thing in a way. Putting the best light on it, right? Okay. What I'm going to do is I'm going to go over this again in this manner. I'm going to take this here, FIFO. You got time to play with your daughter, right, Kelly? I have to move this out of my way. Here we go. Come on, come on, come on. There we go. That's what we want to see, a blank screen. Okay, here's what we're going to do, ladies and gentlemen. We are going to use the same numbers. FIFO, we came up with a cost of goods sold of 6,100, right? And an ending inventory of 6,100. What I am now about to do is get rid of this crapola here. Boy, it's a long way of, okay. FIFO. Let's do LIFO together. LIFO, 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 come on down. Oh boy. I got a bad touch. What I'm going to demonstrate, believe it or not, in the next millennium or so. Come on, Jesus. Ugh. Copy. Okay, thank God. Okay. Now we're going to do LIFO. And we're using the same exact numbers as above. Do you agree? We start with 500, 558, 34, 2,500. Okay. Now, under LIFO, which ones did we sell first? Okay. We sold first the 400 from here, right?
Yeah.
Then under LIFO, we sold the 300 from here. And then under FIFO, we sold what, the 1,500? We sold 1,500, right? Yeah. Under FIFO, we sold this entire 800 here. So that 400, that 300, and now 800. Okay. What was left in the inventory was the beginning inventory of 500, and we had nothing here. Wow, boy, that was like pulling teeth, huh? Okay, here's the key takeaway. Besides, this is not too hard to do, but you can get a little goofed up like I did if you go too quickly. Okay. Under this method here, FIFO, the cost of goods sold was $6,100. Look at LIFO.
We need to change the per unit.
Pardon me?
Cost per unit.
Pardon me? Cost of goods sold. Well, you know what I didn't do here? I didn't put the prices down. Let's see, 804. This would be 6. This would be 7. Here we go. Okay.
The first line 5.
Which line here?
First line.
That's the ending inventory number. This number here?
This number per cost unit is 3.
See this. I see what you're saying. Let me get the right numbers here. 320 beginning. Okay. Da.
5.
Here we go. We sold 700. We sold 400 from here.
Yes, 7.
400 from here. 300 from here. And then we sold another 300 from here. Is that what you're trying to tell me, Kelly?
No, I mean 800 and per cost per unit is 5.
This here is the ending inventory. But hold on one second. We sold 1,500, 400 plus 300 plus 800. We sold 800 at 5.
Yes,
Did I get it right, Kelly?
yes.
Did I get it right, Brad?
And the last line 500. Yeah.
Times.
3.2.
Excellent, thank you.
Yeah.
Pretty easy to goof it up, but as you know, just take your time. I'm trying to work us through here. Now, here's what the important point of all this blundering was. Your cost of goods sold under FIFO was 6,100. Look how much higher it was under LIFO. Okay, under LIFO. LIFO and FIFO. FIFO will give you a lower cost of goods sold and thus a higher profit. I'll say that again. FIFO gives a company a higher profit because the cost of goods sold is lower. LIFO, the cost of goods sold will always be higher. The question is why? Why do you think that is from looking at this? What's the difference between the items we costed here and the items we costed under LIFO?
Because the unit price is increasing over time.
Yes, exactly. Because under LIFO, you are always selling the most expensive item first, assuming that we're in a period of rising prices and a certain amount of inflation, which is the paradigm in any economic structure. So when I'm teaching this, I'm only talking in an environment where prices are going up, which is normal. If the prices were going down, it would reverse itself. For purposes of this studying, just worry about prices going up.
Okay, that's good. I was gonna ask because I know that it flips when prices go down.
Exactly right. Don't make me go through all the numbers here again. We'll be here till Easter. But when prices go down, you said exactly right. It flip-flops. Okay? The reason I don't teach that, and a couple of the other teachers don't teach that, is because if we're teaching students how to handle an environment where the prices are going down, we're telling the world that the economy is falling apart. No economy can sustain itself in a long period of lower prices, okay? It's nice to get a price discount or something, but that's not the same thing. So everything you do in this chapter, think in terms of rising prices. And then you have to be smart enough or alert enough or aware enough that if the problem has decreasing prices, then these numbers would kind of flip-flop a little bit, okay? FIFO, low cost of goods sold, higher profit. LIFO, higher cost of goods sold, lower profit. Why would a company choose LIFO or FIFO? Callie or Kate, do you have any thoughts on that? You run a business. Which one do you think you would want to choose? Oh, come on, Callie, guess. You might choose FIFO because you want to show the highest profit possible on your income, on your income statement. You want to make a big splash. By using FIFO as prices went up, you're going to show a lower cost of goods sold and a big profit. You're going to be able to generate a headline that says, Microsoft announces record earnings of $1 billion or whatever it is. So you might opt for FIFO to generate the biggest income, and you could put a report together and send all this out to bankers and creditors and lenders and potential investors, to the public, that you're doing great. But you may say to yourself, well, that's all well and good. And many of the savvy investors, when they start looking, one of the first things they're gonna look at is our inventory method. So I'm not gonna do that. I'm gonna pick LIFO. I'm gonna pick LIFO because I am going to have a higher cost of goods sold and thus a lower profit, and therefore I'm going to save tax money, right? You're going to pay less taxes because you made less money. Up here, cost of goods sold was $6,100. If we assume that the sales were $10,000, their profit was this minus this, right? And with a 30% tax rate, they're going to end up paying this much in taxes. They're going to pay 1170. Here, because they use this method, they're going to show a much lower, you know. So their profit will be, was that 1,400.3? Not too tough. So look at the difference in tax savings, pretty considerable, right? So you can pretty much choose whichever method you want. Whichever method you want. Now there's certain rules about if you use one method for your accounting records, you have to use the similar method on your tax return. We don't get into that too much, okay? You might choose average costing just to be in the middle. We're talking 6,100, and then average costing would obviously be somewhere in the middle. In fact, we can do that one super quick. If you trust me, real quick. 12,200, right? Where did we say we get the average cost? This divided by this, yike. This divided by this equals $4.88. We sold 1,500, right? So under average costing, we sold 1,500 times 450. I'll do it this way, 1,500. And hopefully this number will be somewhere in between, huh? 7,320 versus the 6,100 versus the 7,200, whatever it was, 61.86, average costing. Average costing, okay? Specific ID, well, that's the one that a company kind of has to use if they're in a big ticket business. You buy a car, they have to know exactly what car you sold. When I go into 7-Eleven and I buy my daily bottle of whiskey here, Coca-Cola doesn't say to themselves, Bob bought that particular bottle at 9:02 a.m. on the 24th of May. You can go and use your FIFO, okay? So let's go back to the PowerPoints. And I don't understand why they don't have this kind of thing in the PowerPoints themselves. And by the way, a couple of teachers are grumbling that they're starting to think they don't like this book, but let's see. Okay, let me share again. Share and share alike, huh? Okay. So let's go through this here. Cost of goods sold and inventory. Cost principle, these are our four methods. Let me move this guy out of the way. I don't think you can see this, but it's very annoying. Okay. Available for sale. That's our whole pool. Available for sale minus ending inventory equals cost of goods sold. Available for sale minus cost of goods sold equals ending inventory. That's the key calculation. And one other thing I didn't tell you, but maybe you're figuring it out, no matter what method you use, total goods available line is always the same. That's your history. Total goods available line. Can you guys hear me? I don't know if could you say something, Kelly?
We can hear you.
Can you? Okay, I can hear you now. My picture froze and I was wondering if everybody was locked out. Okay. Okay, specific ID, cars, houses, jewelry. You buy a $2,000 wedding ring, or a very expensive piece of jewelry. That jeweler has to be able to track that in case of theft. It gets stolen, and then the cops can trace it perhaps to a pawn shop or something. Understand, and I think we do, the inventory costing method has nothing at all to do with the physical flow of the goods, except for specific identification, average cost. The average cost is used in this method. Cost of goods available divided by units available. That's that line, right? The subtotal. First in, first out. We are selling the old stuff first. And the more recent items are in the inventory, which is sort of like the physical flow, but not necessarily. LIFO, the oldest. Mesa Produce up on the Cliff Drive near where I live. They maybe are using LIFO, which they're allowed to do, which means that theoretically they never sold the first banana they put out there in 1940. We know that's ridiculous, but that's the point. It has nothing to do with the physical flow. Let's look at another way and then calculate this on the handout. What handout? Well, you can look at this, a copy from your book. It's sort of a little bit of a summary. FIFO, lower cost of goods sold, like we just said, right? Higher profit, net income will be higher, but you have to pay more taxes, and your asset will be higher. You'll have more inventory. That's a repeat. Advantages of methods, The ending inventory approximates current replacement cost. Okay, I guess that's a worthwhile thing to endeavor. Yeah, if you're using first in, first out, your ending inventory is going to be toward the high end of the pricing as it goes up. So that makes a little bit of sense. Last in, first out. It matches current costs with the revenues, but I'm not sure that's good or bad. It depends on your tax aversion. They're calling these advantages. Ending inventory approximates current. This one matches old stuff. And the average cost, which I don't see there, kind of smooths things, huh? Weighted average. It's a weighted average, not really an average. The different, Kate, you were asking why you couldn't add the prices vertically, because that wouldn't be a weighted average. That wouldn't take into account the units. Okay. Advantages. Some different reasons. Net income effects. Managers choose to report higher earnings, or managers prefer to minimize how much tax they pay. So one method or the other will work for you. And this is what I was talking before, and I think you need to know this for a multiple choice question without getting into great detail. If you use LIFO on your tax return, it's got to be also used for your financial statements. The other methods, you can use two different methods, huh? Maybe one day, those of you who are going to go on with more accounting courses, you'll take Professor Barbara Ali's tax class, and you'll learn you'll learn all about this stuff. Internationally, not interested. And let me move my thing that's got me blocked here. Okay, here we go. You ready for a little bit of a new subject in the same chapter here? Let me move this. Come on now. All right, here we go. Valuation at lower of cost or market. Here's another cost principle. Ending inventory is originally recorded at cost. We know that, huh, from our first 5 chapters. We bought an inventory item for $100, a $100 shirt. And we've been selling that shirt for $200, and we're making a nice profit. That shirt is worth $200, but we cannot increase the value of that shirt on our balance sheet, as we all know now. But what happens if the price, the market price or selling price, goes below the cost? We have to recognize that loss immediately. Ending inventory is thus reported at the lower of cost or market. Selling price, replacement cost, the current replacement cost. What would it cost to buy these goods today? And if we have a sales price that goes below that, we have a loss. And that's part of the principle of being conservative. The conservative principle in accounting simply means you always recognize losses as soon as you are aware of them, but you never, ever record a gain until you actually realize it by selling the item, okay? Lower of cost or market. And we can go back to my template. And this is a pretty good look here, okay? This, I think, is fairly clear. Intel or somebody, right? A company bought 1,000 Pentium chips, and they paid $250. So that would have been $250,000 if we do the arithmetic, okay? Now your salespeople are coming back to you. Callie, your salespeople are coming back. Callie, these things, we can't sell these things for $250 anymore. This is an old generation chip. Not many people are buying it. We're only going to be able to sell this for $200. What's lower here, Callie? Cost or market? Cost or market? Which is the lower number?
Cost.
Cost. So we have to change this 250 to 200. So we have to now say our inventory should be 1,000 times 200. 200,000. You see that, Kate? Cost was 250. The market price or replacement cost is only 200. So we have to recognize a loss of $50 on every one of those. Let me know if this is not clicking yet.
Yeah, this is the part that I struggled with when I was reading through the chapter and I got stuck. But
Aha!
Yeah.
Fret not. Lower of cost to market. Lower of cost to market is what we're going to eventually put on our balance sheet. They bought 1,000 of these for $250. That's the cost. And that was fine. We kept it at that cost for a number of years. But then as things changed, the market value or replacement cost fell below the cost. Every time we sell one, we're going to lose $50. We have to recognize that $50 per unit loss immediately, not when we sell it. So we're going to take that $50 difference and multiply it by 1,000, and that's going to give us a loss in inventory. Where I used to work, this was called cost of goods sold dash lower of cost of market. Let's look at the disk drives. We bought 400 disk drives for 100. We're selling them for 110. What's lower, Kate, cost or market?
It looks cost is lower.
Cost is lower, which means we don't have to do anything. We're good.
Okay.
So our adjustment is simply for the first line, 1,000 times the difference of 50. And there's your journal entry. They're giving you an account called, they're putting in cost of goods sold, which is okay. And most companies have, hyphens after that. Cost of goods sold dash shrinkage, cost of goods sold dash scrap, cost of goods sold dash lower of cost or market. Okay? That make it a little bit clearer, Kelly?
Yes.
You just have to kind of say to yourself, what we want to end up with is our inventory cost. What do you think, Kate? It's coming around now?
Yep. Where did that 50,000 come from? I'm just trying to do some
How
math.
many units did we have in the inventory?
Oh, 1,000.
What did we cost them at?
250.
What should we cost them at?
200.
250 minus 50. 250 minus 200 is 50. $50 each times 1,000 equals the 50,000.
Say that again. I'm so sorry.
Yeah, the cost, we're carrying at a cost of 250. We should be carrying them at 200 each. 250 minus 200 is a $50 loss on each of these 50,000. 50 times 1,000 equals 50,000.
Oh, so you take the original cost of goods
Yep.
and then you take the
Yep,
placement cost and you subtract it, and that's what you debit from the
that is
cost.
correct.
Got it.
That
Thank
is
you.
correct. Okay. Let me go forward here. We're not going to go into LIFO liquidations. Now, I'll double check with my boss. Oh yeah, we're certainly not. This is more for later. Okay. Now, if I may, I'm pulling out the book here. I am pulling out the book. And I don't know if you have your book in front of you. If not, we can work along here, okay? Let me share again. Share. Okay. You see the Excel now again? I'm going into chapter 7 in my book, and I want to talk about a couple of things here. Thinking about things like a walk in the park, things. Things. Bear with me because this is a fairly significant item. If you look at problem E71 in your book, if you have it there, I assume you got the same thing. Okay. See, this is what I find a little bit annoying. In your book, they don't even go over it that much, but I'm pretty sure this will be on the test. And I'm going to talk a little bit about this, and you've got me saying this is proof. I will talk to Cornelia and see how hard we have to hit this, okay? Yeah, let's find E71, please. E71, E71. Oh, boy. You weren't doing anything today anyway, were you, Kelly? Stuff here. The layout of this book, I think, is just dreadful. It goes into these supplements. What the heck? Okay. P7-1. Do you have your book in front of you, both of you?
We do.
Okay.
Right.
Do you see problem P7-1? Is that Travis Company?
I'm trying to find the page numbers. It's really hard to find the page
Yeah, it
numbers.
is. On my book, my book will be a little different because I have a different edition. I'm on around page 375. It's the first P problem. Or if you don't see it, I can put numbers up here and we can work our way through this.
Let me see if I can search for it. Is it E7?
P7-1.
Okay.
Okay, if you don't see it, just give me, I'll pop the numbers in here. It's not so much about the numbers, it's about the theory here. 1700.
E7-1.
1700, 1750. E is the next one. Purchased and in transit. Purchase and in transit. That's 3550. I think this will be worthwhile once we drop the numbers in. Goods purchased, 3550, and then the last two, 700, I guess. And then the last one was the consignment, which is, okay, we'll put it here. The consignment was 950. Okay. What I want to talk about here is something that has to be part of this test. I mean, this is your first problem in the chapter. You have an ending inventory, right? And you went out and you counted it and you had $87,000, okay? $80,000. That's how much you counted. There may be other inventory that you failed to count here that we may need to investigate, or there may be something you counted here that should not have been counted. And let's just get a little glimpse of this. We'll go through this fairly lightly, and I'll check with Cornelia, okay? We send goods out to a customer on a trial basis, okay? We have a machine or something, and we sent it to a potential customer. And we told the customer, why don't you take this machine, work with it, and tell us what you think. We're not selling it to the customer, but it's not in this $80,000. We have to add that to the inventory, even though it wasn't physically in our building. Now, goods in transit. From what I can see in your book, I don't see them talking about FOB at all. FOB shipping points. Oh boy, freight on board. Let me talk about it a little bit. Free on board, freight on board, shipping points, FOB, shipping point, and then there's FOB destination. Freight on board is the point in time where title passes from the seller to the buyer. FOB. FOB. Freight on board. So goods were shipped FOB shipping point. Now, I don't expect you to understand this just from this little presentation. I'm hoping you'll be able to go back to this, and the next time we get together, we'll go over it some more. But FOB shipping point is very important. FOB. It means that at the point of shipment, title changed to the goods. These goods, we ship them FOB shipping point. As soon as we ship them, they don't belong to us anymore. They belong to the buyer. It's his inventory, and we would not count it. Would not count it. If it was FOB destination, we would count it. We would count it. FOB. What I'm going to do later is get a little Excel sheet or something out that you can kind of study on this. In transit. In transit means stuff is on the way. If it was FOB destination, FOB destination means title passed to the seller when he received the goods. Therefore, we would count that 900 if it was shipped under FOB destination. Understand it perhaps this way. We sell something FOB shipping point. As soon as that truck driver signs the bill of lading, he drives out of our campus. We sold one of our old copy machines, say. As soon as this guy drives out of our parking lot and he turns right on Cliff Drive and he gets into a fender bender at the light, none of our business. It's the buyer whose insurance is responsible for it. It's the buyer who has to pay the freight. If it's FOB destination, we own it until it gets to the destination. So if we ship something to my company in Newark, New Jersey, and that truck got into a terrible accident 10 feet outside the factory, we would be responsible. That's what we're talking about, in-transit inventory. Here they're giving you example, in-transit destination. We would pick that up. And then we got a couple more. This one is just common sense, I think, huh? Just common sense. A customer buys something from us, right? A customer buys, like I go to Chaucer's Books every day to get my newspapers, and I often order a book. I call them up and I say, I want War and Peace. And they take my credit card number, and then I pick up the book perhaps the next day. Should they count that book in their inventory? What do you think? Yes or no? They've already sold it. No, it's not their inventory, even though they're holding it for me. If they counted it, it would be a mistake. And we'll go back to FOB. This time we're the purchaser. We purchase something under FOB shipping point. FOB shipping point. That means we own it as soon as it's shipped. And if it was FOB destination, it'd be the opposite. Okay? This one would be FOB destination. And let's talk about the last one, consigned goods, consignments. Are you familiar with that word, Kate? Consignment? What does it mean to you?
To me, it means that if you're only buying what you're going to sell, but I might be wrong in the way I'm describing it.
That is absolutely perfect. Do you hear that,
Okay.
Callie? You're only buying what you hope to sell. Consignment inventory works like this. When Macy's was here, you walk into Macy's, remember they had the perfume bars downstairs as soon as you walk in? Those glass rectangles with the ladies schlepping perfume. That perfume did not belong to Macy's. It belonged to Chanel or Lanvin or some perfume company. The way it works is Chanel says, here are 100 jugs of perfume. See if you can sell them, Macy's. Macy's sells one of those jugs for, say, $1,000, and then they pay us $400 for it. Consigned inventory. We must count our consigned inventory that's out. I did want to run through that. Let me just see what else we got here. Lower cost goods. This is from my last 230 class. We worked with this a little bit. I have to move this thing again.
So under consignment is the sort of theory behind that is that you haven't originally purchased it, right?
Right.
So there's so in terms of cost of goods, how is that factored in? Is that
you paid $400 a jug for perfume, right? And
so
then you sent that bottle to Macy's. Macy's sold it for $1,000. Macy's keeps the $1,000 because that's their sale, and now they pay you the $400 for the bottle that they just sold. Confusing, Callie? I give Macy's a bottle of perfume that cost me $400. I give it to them. While they still have it, it's my inventory. And then a month later, they sell it for $1,000. So that's Macy's sale. But now Macy now has to pay us the $400 we originally paid for that bottle. Okay. I don't want to beat that dead horse too much. Here's another example of lower cost or market. Your new income statement. Nope, more FIFO. That's what we're looking at. Who's Maria? I did something with somebody named Maria. Okay. All right. I think that's a bit of information overload, if anything, on chapter 7. Okay. I think chapter 7 is probably a little bit easier understood than chapter 6, which has some strange rules to follow. But if you understand LIFO, FIFO, the 4 inventory costing methods, you understand lower of cost or market, and the fact that sales minus cost of goods sold equals gross profit, yeah, you should be off to the right start there. Any questions, Callie? I hope you're there, Brad. I hope you were listening in. Also hope we didn't confuse you more than anything.
No, you're good.
Kate?
Thank you.
What'd you learn, Brad? Tell us real quick.
Just the different like accounting types were interesting, like the FIFO and LIFO and special product.
Good. You feel a little more comfortable with this chapter?
Yeah, for sure.
Yeah, this one's a tricky one. Chapter 6 is even a little more tricky. Okay. All right, we want to call it a day. Anybody want to do anything in chapter 6? Kate, did you want to do something with chapter 6?
yeah, I just I have some questions. Just I just struggled with chapter 6. I don't know if anyone else did.
Okay. Do you want to join it, Brad, if you're there, or Callie? We're going to do a little work in chapter 6. You can stay if you like, or you can head out. Oops, hold on. Chapter 6. Where's my cursor? What happened to my cursor? How can you lose a cursor? Hold on. Oh, there it is. There it went. Oh, there we go. New share. New share, chapter 6. Here we go. Okay, you see the slide for chapter 6?
Yeah.
Yes.
I just need to fix this on my end. Okay. Kate, why don't you drive what you wanted to go over, and we'll start at that point, okay? Or did you want me to just go through it again?
Let me just think here.
I bet you had trouble when it came to doing the bad debt expense journal entries.
Exactly. Yeah, if we can just go over that, that would be really helpful.
Yeah. Okay. Let's do this. Let's go through that part of the PowerPoint again, and then let's go into an Excel spreadsheet where I give you some shortcuts, okay? I think this is about, okay. Were you okay on coming from gross to net sales? Did you get problems like that? I bet you did. Okay. Accounting for bad debts, this is a guess. When you're talking about bad debts, there are only two-line journal entries you could possibly write, just two. Even if you don't understand them yet, put them in your scope. You are going to write a journal entry to record bad debt expense. And you're going to do so by either the sales method or the AMAR method. The theory is, this is the matching principle in action. The $1 million in sales that you generated today, we know have some deadbeats who in the future will not pay us. We just don't know who yet. We have to anticipate it now because the sales from this month are what drives the bad debt expense. If we record the bad debt expense in the future months, we would be mixing up the expense and the sale. So let's start by looking at the simple journal entry. On my test, I might start you guys off with a couple easy ones. I might say, here's the number. Record the bad debt expense. You don't have to do any calculating. I'm giving you the number. Look at that journal entry. You debit bad debt expense and you credit the allowance for doubtful accounts. That debit and that credit are always the same. Whenever you credit the allowance for bad debts, you debit bad debt expense. Okay? The number can be different depending on the method you're using to compute the bad debt expense. Bad debt expense is an expense on your income statement. Allowance for doubtful accounts is a contra receivable account. It's married to the receivables. So you know how to write the entry now if you get the number. The problem is, how do we get the number? And this is what your balance sheet's now going to look like. You're going to see accounts receivable. And I've gotten a few emails from students who are confused when your book uses the word trade receivables. Trade receivables and accounts receivable are the same thing. So we have $1 million worth of customers that owe us money, but we don't think we're going to collect 100,000. The net would be the difference. This is the amount we expect to collect. Now, again, without having to calculate anything, when we know a particular person is not going to pay us, we're obliged to write that person off. Write it off. I noticed Cornelia included that silly little bit from Seinfeld when they were talking about writing it off. If you didn't see it, it's in Canvas. It's kind of a funny little thing. So here, they're giving you the write-off. This means that a particular customer is not going to pay this nearly $7 million they owe. How did Decker find this out? Well, after 30 days, they weren't paid. After 45 days, they called the guy up. Hey, when are you going to pay us? After 60 days, the guy didn't pay. After 90 days, at that point, we started to yell at the guy, threaten him. And then maybe after 120 days, we turned on the news and see that this guy was arrested for fraud. He has no money. In other words, as soon as we know to a pretty much an empirical certainty we're not going to collect, we write off. What are we writing off? We are writing, wow, it's taking a long time to get to this journal. We are writing off the receivable. We're writing it off. We're erasing it. We're erasing that customer from our aging. We've already recorded the expense in the prior months. So all we're doing here is we're using this allowance account to record the other half of the write-off. We are reducing accounts receivable with that number, and we are reducing the allowance account, which is a contra receivable item with a credit balance. So here they're giving us an assumption. AR was 62 million. The allowance was this. And now we're going to write it off. And this I do want you to look at a little bit. Accounts receivable, huh? At the end of the month, we had this much in accounts receivable. We had this much in the allowance, and that was our net receivable. Let's pretend this is as of June 30th, 2020. Today is July 18. And sad to say, we found out that Brad's company is not going to pay us, huh, Brad? Brad's company went out of business. We know he's never going to pay us. So we recorded this journal entry, which means we credited accounts receivable for $6,969,000. It reduced that, and it reduced the contra account by the same amount, leaving that balance. The key point is writing off an account has no real effect on anything. Writing off an account does not affect your income statement, and it really doesn't affect your balance sheet in the sense that the net receivables remain the same. All we did was move this part of receivables into here. Make a little bit of sense so far? I see confused faces, no?
I'm just looking at the formula that was part of the Chapter 6 exercise that
Yep.
shows the two sides. So the debit side has sales on account. Is that the accounts receivable account?
Sales on account would be a debit to accounts receivable, yes.
Okay.
Sales on account would be a debit to accounts receivable and a credit to sales, yeah.
And then on the credit side, it's collections on account and then write-offs.
Yes. Yes.
Can you explain the collections on account part? Where did that?
That just means the customer paid us. We sold something for $100 today. You sold something to me for $100. The deal is I pay you in 30 days. So you debit accounts receivable and you credit sales. 30 days later, you get my check in the mail. You debit cash and credit accounts receivable. That's all.
Okay. And then write-offs is just it's just what you've written off.
Right. Yeah, exactly. Write off. You sold me $100 January 1st. You've been pestering me for 7 months to pay, and you've given up trying to collect it.
Okay.
That's a write-off. Now you credit accounts receivable. It would be lovely if you could debit cash, but no, you have to use that allowance. That allowance for doubtful accounts is an allowance your mother gave you, but you can only spend it on school supplies. It's just a very specific allowance. Okay? So hopefully we know the debit and credit, of the two and the only two journal entries involved with the world of bad debts. At the end of the month, you debit bad debts expense and you credit the allowance. Then you might every day have to write somebody off. And when you do, You're going to reduce the allowance with a debit and reduce the AR with a credit. And when I first got out of school, I was working for W.R. Grace Company in Jersey, and our policy was you write off. I had to go in there, I guess, every couple of days at the aging, and I had to write off any balance over, I don't know what it was, 90 days under $10, for example. That was part of our policy. And I was involved in coming up with the bad debt expense number. That's one of the first jobs they like to give new people. At least I always like to give that out to a new person on the group. Two methods, one easy, one tricky. The percentage of credit sales. All you do is take your credit sales, multiply them by percentage, that's your bad debt expense. Credit sales times whatever percentage your company uses equals the bad debt expense. Kids Clothes they might have had 2 million in sales, but only 600 were credit sales and thus were sent to accounts receivable, right? They debited accounts receivable for 600. But they know from experience and whatever knowledge they have that they're probably never going to collect 1% of that. So Callie, tell me the journal entry. What are we debiting credit for $6,000? We're recording the bad debt expense, right? So here's your, take a look at the journal entry. I know it's a little tricky when we get started. You debit bad debt expense and credit the allowance. You good with that, Kate?
Yep.
Any questions on that, Callie?
No.
You okay? All right.
Yeah.
So that's pretty easy, right? The sales method's pretty darn easy. The next method is the proper method. It's the one used by probably the whole world because you're looking at all of your AR at once. With this method here, you could have, let's say this company had $1 million in accounts receivable, okay? And they're only looking at the sales for this month to come up with their bad debt expense. What if unexpectedly a customer from 3 months ago went out of business for $500,000? You would not have that covered here. You'd be all fouled up. The receivable method. This is what I've always seen. Agings. Boy, you do a lot with agings. One of the real pain in the neck jobs in any accounting office is sit down with the accounts receivable aging and give responsibility to someone to try to collect this stuff, try to find out why it's getting out too late. So we're going to focus on the allowance for doubtful account through accounts receivable. And this is a nice, simple look at an aging. This company might have 100 customers. They're just showing you the first 3 and the last one. Aaron owes us $235. This guy owes us $1,500, etc. Let's see. You work for me. You're sitting down and you say to yourself, "Okay, Aaron owes us $235. He's in the 1 to 30 column. Not too worried about that." AR here. This guy owes us $1,500. $1,200 isn't even due. We're not worried about that. And again, he's not too bad. But look at this guy. He owes us $750, and he hasn't paid this bill for 90 days. He hasn't paid for this shipment for 61 to 90, and the most recent sale lapsed out 31 to 60. Well, the first thing you might do if you're working for me or anyone else, you might cut that customer off immediately, right? No more shipments till this guy pays. Zach, he's 31 to 60, so we're getting a little bit worried. Our experience says that if it's not yet due, we're only going to lose 1%. The number gets higher as the debt gets older. And that's pretty much common sense, huh? So let's take a look. You multiply down and add across. No problem with that, Callie, doing that calculation? You multiply the total of the column times the percentage we expect to lose, get your dollars, do the same for each column. Okay there, Kate?
Yep.
Okay. Now here's the tricky part. True or false? That 1201 is the bad debt expense. True or false? Why don't one of you pick one?
Say
The
that again.
answer, true or false? Under this method here, we're looking at the aging. That 1201 we just calculated is the bad debt expense we're going to record. True or false? The answer is false. False. Because that 1201 is not the bad debt expense. It is the balance we want in the allowance at the end of the month. You understand what I mean, Callie? That 1201, we want that to be the ending balance in the allowance.
Why do you, oh, because you actually, why do you want that as the ending balance, I guess is the question.
Good question. Because I said this is the better method. Under this method, what are we doing? We're looking at everything. So at the end of the month, we're sort of reinventing the wheel. We're coming up with this number based on all of the knowledge from our AR. Under the sales method, we're only looking at 1 month. So we're just layering that 1 month on top. When you use the AR method, you're calculating what you want the allowance to be. And what they're saying here, this is our ending balance. That's what we had to have, an ending balance. They're telling us the beginning balance is $50. So what do? Just a simple example. They don't have any write-offs or bad debt expense recorded. What was the balance? What is the decide? What do we need in the ending balance? 1201. They're telling us that 50 is already there. The difference is 1151. Okay. 1151. And I'm going to move over here for just a second, please. Tired of sitting in the dark. You can see me now? Good morning, all. Okay. This is the little bit of the confusing part. Does this help, Kate? Understanding sales method, you're computing the bad debt expense. Receivables or aging method, you are computing the desired or ending balance in the allowance account, okay? Should I go on, Kelly?
Yes.
Here is a T account for the allowance, okay? And they're just showing you, here was the balance here. You see that 1151? That's the credit to the allowance, right? That's our bad debt expense that we computed here. Here is my point. Anytime you credit the allowance, you're only going to debit one account. What is that account? Whenever you credit the allowance, you're only going to debit what? Bad debt expense. No exceptions, right? So looking at this T account, you know automatically that the debit, I'm so sorry, you know automatically that the debit had to be to bad debt expense. Suppose you saw a debit to the allowance. What is automatically credited? What are we writing off? That's a write-off.
Accounts receivable?
Yes, good, exactly. You good with that, Callie? Any debit to the, what's that?
No, I'm gonna say.
Okay. Any debit to the allowance account automatically means a credit to accounts receivable. Any credit to the allowance account automatically means a debit to bad debt expense. Remember our 2 journal entries? Our 2 journal entries. Let's go back. Here is recording the bad debt expense. You notice we credited the allowance, so you automatically debit bad debt expense. And then the write-offs would be a debit to the allowance and a credit to accounts receivable. Okay. I would have that T account in front of me when I'm doing the homework. It might provide a little bit of comfort, huh? It might provide comfort. Suppose there was $1,000 sitting here. You would come up with a different balance because you'd have to go 50 minus 1,000. That's 950. It's a minus 950. We got to get up here. It would be like 2150. Okay. Now here they're just trying to let me just look here real quick. Okay. T account, important. And then they give us a little more practice here. Under the aging method, accounts receivable times the percentage is the allowance amount. Now we have to go to the general ledger and see what the balance is in the allowance account. It might have been $1,000 at the beginning of the month, and we had $800 in write-offs, so that would be $200. And we record the journal entry. And I don't particularly like this. If it's a debit balance, you'd have to add it, but that's just arithmetic, and we'll look at that in a second. Okay. Okay. So that was a little look at the bad debts world. Did that help a little bit? Okay. You want to get into the contra revenues and how to record those entries?
Yes, please.
All right, here we go. What we just completed is the hardest part in this chapter, which I think is maybe the hardest chapter in the book, to be honest with you. We have sales, right? We sell $1 million worth of shoes to the world. And we debited accounts receivable and we credited sales. And just like we know that some customers aren't going to pay us, we also know that some customers are going to return goods to us. We know we're not going to collect everything we sell for 3 different reasons: the use of a credit card, or if a customer takes a sales discount, or a return allowance. So here we go. I went into Deckers and I bought one of my famous Australian sheepskin boots for $3,000, right? They swiped my credit card, and all I know as the customer is they took $3,000 out of my pocket, right? Well, what happened here? That credit card discount, or credit card fees, as it's more commonly known, is a contra revenue account, because Deckers is not going to get $3,000 in cash. They're going to get credit for the sale of $3,000, but the credit card company took $90 out of my $3,000 I gave them. So the debit to cash is $29.10. I don't care if that says accounts receivable. Debit to cash is $29.10. Now, if Cornelia is watching this, she will disagree with me again.
Why doesn't it say cash if it's a credit card purchase?
Well, because Cornelia makes the point that sometimes you don't get the money instantly. It might take a day. And so technically it's a receivable for a certain amount of time. But it's really cash. It's really cash. Okay. Are you okay with that, Callie?
Yes.
Pretty easy, huh?
Why do you credit sales revenue
You sold it.
1,000? Okay.
You sold me these fancy shoes for $3,000.
Okay.
And you notice you debit credit card discounts. What's the account you never debit? Oh, come on now. What's the account you never debit? Never, never, never.
Cash.
Oh, no, bad guess. We love to debit cash. It begins with an S. Sales. You never debit sales. Never. Never. I will play this debit sales song here. You never debit sales. Never, never, never. But you have to reduce your gross sales to net sales, and you do it not by debiting sales, but by debiting the contra sales account. So on your income statement, you're going to see gross sales of 3,000 minus credit card fees, which would give you the net sales in this small example. Anybody confused by that? Gross sales.
I think I'm confused by the fact that credit card discounts.
Yeah, why not?
Why is it a debit? Right, Callie?
You
Yeah.
sold $3,000 worth of stuff to me, right?
No, just the 90. Can we change the credit card expensive?
No, it's not an expense. It is not an expense. And let me go into further detail. You're asking good questions. You see the 3,000 here?
Yeah.
Wherever you see the sales number, it's always going to be the units times the sales price.
Mhm.
Let me say that again. Let's say these boots were $300 a piece. Your sale would have been 10 boots times 300, $3,000 sales. You have to put the whole sales dollars here because that's a legitimate sale. And that's what you want to see on your financial statement. That's what the sales department is going to use to analyze. This is what you want to see here. Now, in order to make that $3,000 sale, yes, we had to give away $90. But it's not considered an expense. It is considered a reduction of your gross sales. It has the same overall impact as an expense. What you can't call it an operating expense. There's nothing to do with running the business. It has nothing to do with making shoes, selling shoes. It's a customer option we give. Does that help a little bit, Callie?
Yeah.
This will always be units times dollars. Units times dollars. There'll be no exceptions there. Debit, credit card expenses. It is, you got me saying it now, Kelly. Credit card discounts, okay? All right. Callie's a wise guy. All right, sales discounts. You ready? We sold $1,000 worth of boots, 210 net 30, huh? We know how to read that, right, Kate? Can you read that for me, please?
Read
210, what does that mean?
so 2% discount net 30, or sorry, net 10. So you get 2% off if you pay within the 10 days.
Otherwise,
You pay the regular price up
Right.
until the 30 days.
yeah, you pay the net. That you understand that, right, Kelly?
Yeah.
2% 10.
Mhm.
Okay, so they sold boots with those terms. Now they're asking us to record the sale entry. The sale. Wow, I don't see this discount there, do you? No. This is just the sale. They sold $1,000 worth of boots on credit. We can't record the discount until the customer actually takes the discount. So now this guy has to pay us by, I guess, the 16th of January, right?
Yeah, I think this is the part I would have totally gotten wrong because I probably
Okay.
would have factored in the
That's an easy mistake to make. You don't worry about the discount at the point of sale. It has nothing to do with the sale, okay? Now he paid us on the 14th. He is allowed to take that discount. Again, what is the account you never debit?
sales.
Yeah.
Sales. You never debit sales. You never debit sales. And you never credit purchases. You never debit sales. So take a look at the numbers. How much did we sell? 1,000. We gave the guy a $20 discount, so we only got that amount of cash. So that journal entry writes itself. You debit cash for $980. You record the sales discount, which is not expense, but it's a contra revenue. That's what that X means. And the receivable is 1,000. When we recorded the sale, how much did he owe us? $1,000, right?
Yes.
And he either pays us the 1,000 or he pays early and we give him a $20 break. Okay?
I guess at the end, at the balance sheet, the contra accounts factor in the end, even
On
though
the income statement, not the balance sheet.
but it's a contra asset. So
This is not a contra asset here. Allowance for doubtful accounts is a contra asset. This is a contra revenue.
right. So it's on the income statement. Gotcha.
Yes. So let's pretend this is your whole month. Your first line would say gross sales, less sales discounts, and that would represent, in this case, net sales.
Net sales.
Gross
Got it.
to net, okay?
Okay.
What if the guy paid us late? He didn't pay us till the 20th. Well, now he has to pay the whole thing, right? But like we talked, we're not necessarily going to go try to collect it, are we, Callie? Would you call this guy up and say, hey, you owe me $20? Would you do that if he took the discount late? You might. You might do it if it's a first-time customer to get the ground rules set. But boy, nothing could possibly irritate a good customer more than nickel and diming them on something like this. So probably you would just say, that's fine. Okay. Sales returns and allowances. Same thing. The cost and the same thing. We have to look at what did we sell? We sold 500. You returned a pair of the boots. And our policy is we accept returns. So we're not going to debit sales. We're going to debit the contra revenue account called sales, returns, and allowances. This is a return. An allowance might be, we're returning these boots, and we say, would you do me a favor, keep the boots, and I'll give you $200 off on it. That'd be an allowance, okay? Here they're returning $500 worth of boots. They cost us $300, right? So before paying, they return the boots. We have to record both the cost and the sale and the return. Ta-da! You can do this in one journal entry or two, probably easier in two. He doesn't owe us $500 anymore, right, Callie? If you return boots to my shoe store, do I then say you have to pay the $500 for them?
Yes.
That's what. No, that's why you return. I'm going too fast. No, you returned merchandise to me for credit. You returned merchandise. You bought a toaster, and the toaster didn't quite work right, so you brought it back to the store, and we say, okay, we'll take it back. So they're going to credit accounts receivable. You don't have to pay for it anymore, right?
Yes.
It'd be great if you return something and you still have to pay for it. That'd be wonderful, but it doesn't work that way. You never debit sales. Never. You debit the sales returns and allowances, huh?
Makes sense.
Mhm.
Well, we also have the cost side, right? We have to bring the merchandise back in. So we cost 300, debit merchandise, and we credit cost of goods sold. This here is just a reversing of what we did when we sold it. Make some sense, Kate? Oops, sorry.
Yeah, it's starting to sink in. Thank you so much for taking the time to walk through this again.
Anything else you want to go over? We got bank recs and stuff. Or what do you think, Callie? You know this whole chapter now perfectly?
Oh.
Have you been checking your grades on Canvas at all?
Um, I already finished chapter 7's quiz, but the score is so low. But I don't know why. So next Tuesday, can you explain the chapter 7's quiz problem?
Yep. We'll go over it again. Yep.
Mm.
Yeah.
Because I can't see the result.
What's that?
I can't see the result.
Oh, yeah. You can't see the result, huh?
Yeah.
Okay. I got to talk again. Speak to my boss about getting you access to those quizzes. Okay.
I think they
We'll
come a
have
little
plenty.
later. Like I just got my chapter 6 results like a few hours later. Like you can see your score, but you can't see the like what you did wrong or
Yes.
right.
You still cannot.
But I'm able to see that for chapter 6 now, but it took a little bit. So maybe it will just take time.
Are you saying you were able to see what you did wrong in chapter 6?
And yes, I was.
Okay. All right, Kelly. Maybe there's a time lag there of some kind. It may be that it's deliberately set up that way to prevent cheating. I don't know.
I think once I got the email, the automatically generated email from Canvas that say your assignment has been graded. That's when I was able to go in and look at it. But until then,
Yeah. Okay. That might answer it then.
so I don't know.
Because I do get a lot of questions from students, and I'm telling them that you should be able to do it without really satisfying them because I haven't figured it out. Okay, so that might be the trick.
I know George was having trouble seeing some past
Jordan?
George.
Oh, George. Yeah, George didn't join us today. George, yeah. By the way, just to finish up, perhaps going back to bad debt expense. My company, your company, and my company compete, right? We go after the same customers. My company had 0 bad debt expense in 2019. You had $100,000 of bad debt expense in 2019. Which company do you think did better overall? What I'm getting at is this. Companies expect some bad debt expense. They want some bad debt expense because my company, Kate, and you and Callie run a company. My company and your company were $1 million companies last year. At the beginning, I had no bad debt expense, and my sales grew from 1 million to 1.5 million. No bad debt expense. You had $100,000 worth of bad debt expense, but guess what? Your business grew from 1 million to 4 million. In other words, you have to take a certain amount of risk in issuing credit. And if you're issuing credit and month after month goes by and everybody is paying you, no problem, it is a problem because there could be a whole world of slow paying or less liquid customers out there with whom you could be doing business. So you would gladly trade 100,000 in bad debts for an extra millions in sales, right? Just a little point there, that's all. All right, we good for today? Anything else you want?
Questions on quiz, chapter 7 quiz. which I'm
What's
curious
that?
to you.
Okay, when you get we'll get together. Now, if the both of you want to hook up again over the weekend, you can just text me. Texting me is the best way. Kate, yesterday, to be honest, I didn't even look at the SBCC email system until I got home late. So texting is the best. My personal email is better. At least then I get a friendly beep or something, you know?
Okay. It
All
wasn't
right.
dirty, though, but thank you so much for making extra time today.
All right. Good to see you all. Callie, time for the friendly
you.
raccoon wave. Do you know what I mean by the raccoon wave at all? You don't, do you?
Is this it?
Yeah. Have you ever heard of the Honeymooners?
Nope.
You never heard of the great show, The Honeymooners? Okay, that was they were in a stupid lodge, these two guys, like the Elks, you know what I mean? The Elks, and they had raccoon hats with the tail. And at the end of the meeting, they ended the meeting with the friendly raccoon. Woo! I'll send it both to you. You need to know that, okay?
Oh,
Okay.
I would love to get if you could share the template that you were just using for chapter 7 that shows.
Oh yeah, that Excel thing.
Yeah, if you could share that Excel thing, that would be amazing.
Yeah, that'll be on its way shortly. I just gotta polish it up just a little bit.
Perfect.
All right, off we go, everybody. You take care.
Bye.
Bye-bye.
Bye.